Guys, go ahead and eat. This is your hour. Can you guys hear me?
Yes.
Do I need this thing?
Yes.
Yes. Feel free to pepper me with questions at any time during the presentation. Again, this is your time. I want you to get the most out of it. So if we want to take detours and sidetrack and go off of what I've prepared, completely fine with me. So let's get started. Inflation's been a big problem. I think we've all probably recognized that. I'm going to argue today, things are actually looking pretty good. Okay, and feel free to beat me up on this. I've spent 17 years in the Federal Reserve System, and every single month I dig through the price data. I don't think I've missed a month in my entire career. So I know this stuff kind of backwards and forwards. And I'm happy, if you disagree, to convince you you're wrong. Okay, so inflation has actually decelerated markedly in the last couple of months. Supply chain constraints, for the most part, have been largely resolved. But the labor market remains tight, but we're seeing signs of some slowing. So what I wanted to do today is kind of talk through some of the conflicting data we're getting at the moment. We're getting some sign that GDP is looking much more resilient than it has. Output growth in the economy looks much more resilient. But there are some other signs that suggest that softening's continuing, and I want to walk you guys through that. Again, if you want to quibble or argue with me, that'd be fun. And then this conflict in the data, the parsing through everything to try to figure out whether or not the Federal Reserve has done enough with interest rates at the moment, or whether there needs to be a little bit more done. Sort of depends on how folks are reading the tea leaves here, or how they're reading the incoming data. And I want to walk through that a little bit. So I don't know if you guys can see this. This is just a headline PCE inflation rate over the last 12 months and 6 months. Over the last 6 months, it's down to about 2.6%. So it's slowed in recent months. Oh, can't stand in front of there. But what I wanted to do is dig a little bit further. Let's get into the weeds. Okay, this is a group. We're all financially literate here, right? We can all dig through this stuff. What we have on our website. Can I close that box? There we go. What we have on our website is something we produce on a monthly basis. It's our underlying inflation dashboard. Okay, it's kind of a quick read on all the different underlying inflation measures to try to figure out where that trend's at. Okay, so there are a lot of different price shocks buffeting the headline numbers, and we want to kind of see through some of those relative price changes and get at what that underlying trend is. That gives us a better forecast of where inflation's likely to go. You're going to see a lot of red here. These are, and you don't have to pay too much attention to the numbers. On a year-over-year basis, things are still very elevated. Okay, we're still coming down from very high inflation readings. But if I look over the last couple of months, and these columns here compare August of last year to August of this year, we're starting to get some signs that inflation's softening. And we're starting to get some incoming monthly readings that are pretty darn close to where we want them to be. And in fact, I think next week's release, or the next CPI release we get for September is likely to confirm a lot of what we're seeing here. Here's maybe a different way to see it. Yes?
I was going to ask about what is a sticky price, so you just anticipated my question.
Yes, the sticky price CPI is something a colleague of mine put together back in 2010. It basically is a collection of the underlying prices in the CPI that change price infrequently. Okay, they're slow to react to changes in the economic environment. There's some sort of impediment on the part of firms that are acting in these spaces that keeps them from adjusting price quickly. Okay, so you can think a classic example here is like rents or a cup of coffee at Starbucks. Those don't change every day. Rents change on average about once a year. Inside these sticky prices, we think that there's an embedded inflation expectations component. Those firms that operate in these spaces have to be thinking about the forward projection of economic growth and inflation when they're setting price today, or at least their own nominal marginal costs and sales revenue. And what we've seen out of this figure over the last 3 and 6 months is it's down around 2%. That's actually pretty darn good. In fact, another way to sort of see the improvement in the inflation picture is just to look at all the prices in the market basket. Let's order them from the lowest price change to the highest price change, okay? And then let's look at that distribution of prices. So one thing we saw during the pandemic and the supply shock period, especially in mid to late 2021 and in 2022, is this started becoming elevated. And this is the share of the CPI rising at rates greater than 5%. Okay, no one would argue that 5% is kind of where we need to be on average, but about 60-70% of those prices in the basket were rising at rates in excess of 5%. All right, that's a problem. That's come down markedly. We're at about 27%. I'm sorry, about 37% on average over the last 3 months. A typical look at this would say something right around 15 to 20% is quote unquote normal. Okay, so we made significant progress here in the price change distribution. A lot of those outsized price increases are starting to come back, and if I plotted the entire distribution of prices, you'd see a huge tail shift during 2021, 2022. That narrows up, and the center mass of this distribution is starting to look more or less like we want it to look. In fact, in here, I'll take any argument. If I cut this the way that the Wall Street Journal, Financial Times, everybody started paying attention to the price change distribution and the underlying CPI in this way, looking at core services, core goods, and this sort of super core measure. You guys have read about this, right? This is core services ex shelter. So it excludes shelter prices and energy prices in the core services components. So we can see, well, actually, we can't really see much. I think you guys are going to have access to this slide deck, so you can peruse this at your leisure. Those orange bars are the core goods. The blue bars are that super core, that core services ex shelter, and the green is shelter prices. You can see at the outset here, early 2021, we started getting supply chain constraints. Core goods responded instantaneously to that and remained elevated. A lot of that was the used car story. Again, supply-driven or pandemic-driven price changes. Those look a lot more normal now. Core services is actually slowed appreciably. And if I just project out those two series, kind of where they've been over the last 3 months, and I assume that rents inside the CPI or the shelter prices inside the CPI start to follow what we're measuring in market-based price changes. So when we look at the Zillow rent index or some of those other real-time metrics we're getting on the housing data on rent, they should slow. And if they slow to something that's even maybe a little bit more elevated than usual, like 3%, the underlying inflation trend is going to be right around 2.1 on a CPI basis, which is actually a little bit soft relative to the CPI. Now, that's just taking the latest data and projecting forward without any sort of modeling or economic intuition behind it. That's just saying there's a possibility that in very short order we'll be at what the Fed would consider price stability. So I wanted to walk through how plausible that situation is with you guys today. By the way, anybody think that this isn't going to happen? Any takers? Oh, I wanted to have some fun. There we go. Oh, shoot. Yeah.
So do you
You mean going too low?
Yeah.
I don't think most folks are worried about that. And in fact, one interpretation of the longer run strategy, what the Fed's trying to do now, is instead of just looking at, one interpretation of this is instead of just looking at forward prices, they're taking some sort of average. They've not defined average. They haven't defined it for me either. I don't exactly know what this average looks like. But coming off a period of very, very high inflation, 8-9% inflation, if things ran a little bit south of 2%, I don't think anybody would be upset about that. That wouldn't be a problem unless it started to really slow and really soften down below 1%, and then that would be a sign that maybe we've the FOMC has overshot things and needs to course correct. But I don't think that's a salient risk. In fact, a lot of the chatter around what's happening with inflation is this sort of the last mile is going to be the hardest. We've got it down, the underlying inflation trend's down around 3%-ish, maybe a little bit below that by my calculations. But then there's a lot of question on whether or not we can go from 3 to 2 and how quickly. And in fact, most professional forecasters would suggest, so if you looked at the NABE Outlook survey, the majority of professional forecasters don't see the Fed hitting their target at least until 2025. Right, so this is that sort of last mile thing. Now, and I'll come back to you. Now that last mile argument, it's not really based on a whole hell of a lot. Okay, so we can look, so first, and I'll be completely forthright, all of our macro forecasting models broke during the pandemic. Completely fell apart. You wouldn't have been able to concoct a scenario in real time where the sort of standard aggregate Phillips curve models that the Fed uses got anywhere close to 8-9%. You couldn't have done it. So that's a long way of saying that the only real argument folks have on this last mile stuff goes back to the Volcker disinflation period. All right, so we suffered this very high inflation rate. Inflation expectations became unanchored. After Volcker jacked up overnight rates and into the 20s, inflation fell quickly, but then stayed at around 4% for quite some time, for about 5-7 years before it really started to slow to something we would now consider price stability. Back at the time, we didn't have that explicit target though. But that's really the only episode in history that we can go back and say, oh, when you had really high inflation, it took a while for things to get back down. Now, I think part of the argument there, and I'll steal some of my thunder later, is that inflation expectations became unanchored during the late 60s through 80s time period. I don't think we have a lot of evidence that suggests that inflation expectations are unanchored now. In fact, long-run inflation expectations by just about any measure you can find have remained relatively subdued and haven't reacted forcefully to the incoming evidence over the past couple of years. Yeah?
Yeah, so Brent, looking at this sticky CPI, which has 5.6, what's the target for, if I was using this sticky CPI, what would be the target that we would need to get to where everybody feels good about that sticky CPI?
Yeah, that's a great question. You can find the answer on our website and that underlying inflation dashboard. Shameless shield plug for the Atlanta Fed's website. Right around 2.7%. And again, the most recent 3-6-month readings are at or below that range. So we're really starting to see things, a lot of these pandemic-related price changes and a lot of the increase that we saw during that pandemic, it's coming on. Yes?
So I remember this time period with Paul Volcker. My first mortgage was 10% plus
Yes.
points.
Yes.
But it was a completely different demographic profile. You had all of these baby boomers rushing into the market, pushing up prices, and right now you've got the exact opposite. You have more 65-year-olds than you have children.
Yes.
So I'm wondering to what extent first of all, like, secondary question that I was going to get to later, but what level of immigration do we need at least to get to some sort of balance?
Sure.
Not as many people who are spending as old people who are not. But doesn't that influence the pattern going forward?
Absolutely. Absolutely. When you think about, and this plays into an argument that a lot of macroeconomists have had over the last maybe decade or so, the notion of secular stagnation. And that depends a lot on the aging and the demographic shifts of the U.S. And we are seeing that the U.S. on average is graying. One thing that we can look at more near term is what's happening with labor force participation rates. So it's very true that labor force participation rates for those 55 years and older fell during the pandemic and have stayed low. A reassuring sign is that for prime age individuals, that labor force participation rate is back up to pretty close to where it was in 2019. And we did see over the last 3 years, immigration fell off of its trend, or off of its long run trend. There was a shortfall, don't quote me, I think it was about a 1.5 million worker gap there. That's since closed. So that's come back. Now, maybe not in a distributional way, the way that the economy maybe needs it now. I think we still have a lot of excess demand for highly skilled folks, especially in IT and in healthcare. So that maybe hasn't come back in a distributional way like it would, but the overall levels are increasing again and have converged back to the sort of trend that we'd want to see that at. But you're right to think that should labor force participation rates stay low in the environment that we're in, there's still a relative lack of labor supply, and that could keep upward pressure on wages, which could feed through into prices. We can have that sort of Phillips curve argument maybe later on if you want, but let me move forward. Any other questions? These are great, by the way. Okay, so I'm going to maintain that things look really rosy right now, okay? Maybe rosier than most other Fed folks. I'm not going to say the committee, I can't. Oh, by the way, this is a really good time. We probably couldn't read it on the first slide. These are my views, mine alone. They don't reflect the Federal Reserve System or the Federal Reserve Bank of Atlanta. It'd be nice if they did, but okay, so I'm speaking on my behalf. Okay, gosh, we can't see this at all. But the other thing that's given me some confidence here is that, at least historically, we run some surveys out of our shop in Atlanta, and one of them is the Business Inflation Expectation Survey that surveys Southeast C-suite execs, business owners. And their notion of where unit cost growth has been, so their unit cost realizations or the costs that their firms are facing to produce that additional unit of output, that's aligned really, really well, very closely with sort of aggregate inflation data. And this is a little stale, that's coming down. And the expectations for unit cost growth, and I don't know if I had, expectations are coming down as well. They're not quite back to where they were pre-pandemic. There's an argument that maybe they ought not to fall back down to below 2%, because if we look at inflation over the last expansion, on average it was about 1.7%. So we're at about 2.5, anywhere close to 2, I think would be considered in the range of price stability. So we're still seeing that move in forward-looking expectations for unit cost growth. Okay, the other thing that I wanted to point to is that in some research that I have using these unit cost expectations, a lot of what we saw during the pandemic was supply-related impacts on costs, which pushed up prices. Okay, those have arrested now, and we're coming back down to sort of a more, I don't have a better word for it off the top of my head, more normal conditions, economic conditions for firms to operate in. I'm going to skip ahead. So yeah, basically about 40% of the increase in individuals' unit cost expectations can be directly attributed to supply chain disruption. That's arrested. We're seeing that come down. Okay, now let's think about the outlook and how plausible my Goldilocks sort of scenario, or what Austin Goolsbee refers to as maybe the golden path. How plausible is that? Well, it depends on at least three factors, probably more. The first is the forward trajectory of the economy. Are we continuing to see this strong growth, which we would think would put upward pressure on prices going forward? Are we seeing a significant slowdown at the moment, a meaningful slowdown in the data? Expectations matter here. I already covered that a little bit. And then monetary policy and fiscal actions matter here too. How aggressive the FOMC is going to be going forward with tightening, and they've been very aggressive over the last year or so. How long will the FOMC remain in a sort of a restrictive policy stance? Matters for especially for inflation going forward. And the other thing is, there's been over the last couple of years, there's been an announcement of a trio of stimulus packages by our fiscal authorities, including the Inflation Reduction Act, the CHIPS Act, and the bipartisan infrastructure bill. That's adding about $2.1 trillion-ish, depending on how much uptake we have on for households on electric vehicles, and what that $7,500 tax credit, how much that stimulus really buys us. But about $2.1 trillion in additional stimulus to the economy. How that plays out is going to affect the forward trajectory as well. Okay, real GDP growth. And I cut off the decline there during the COVID recession and the quick rebound. So we could zoom in here. Even after revision, and we got that earlier, late last month, a week or two ago, real GDP growth on average is about 2.5%. That's a little bit stronger than where we think the potential growth rate for the economy is. We think it's about 1 3/4%. So it's still a percentage point or so above that trend. That if that is the true accounting of what's happening with output growth, again, that puts more pressure on the labor market, more pressure on wages, potentially more pressure on prices. Along with resilient GDP growth, and that's through the second quarter. Again, shameless plug for our department. You guys, anybody who watched CNBC has probably heard the term GDP Now. A colleague of mine puts this together, and it's a nowcast of current quarter GDP growth that attempts to mimic the BEA's procedure for how they're basically adding up the expenditure side of the economy, and then uses econometric techniques to fill in the data that we don't yet have in hand. That's been really strong for the third quarter, about 4.9% as of the last reading. Again, that's putting upward pressure and adding gravity to the story of the resilience of the economy, and calling into question for a lot of folks the transmission of tight monetary policy onto economic growth. So there's an argument right now that's happening in monetary policy circles about whether or not we've seen the sort of peak impact of tighter policy on the real side of the economy and on inflation. And typically, like historical estimates, say anywhere from about 9 to 12 months after the Fed has gone into restrictive territory, which in my view, the Fed didn't really get into a restrictive territory until maybe late last year, early this year. So we're about at the point where we ought to be seeing slowing real side growth. And then on inflation, that lag takes a little bit longer. Again, in large part due to price stickiness or the slowness of all prices to adjust to what's happening on the real side of the economy. It takes about 12 to 18 months, I think, on average. Some estimates from macro models say maybe 24 months. But we're starting to come into this period where we should be seeing the restrictiveness of policy play out. If in fact this continues and we continue to see very strong real GDP growth and tight labor markets, there's likely to be an argument that maybe monetary policy is not restrictive enough. Questions? Yes?
A couple minutes ago, you said potential real GDP growth is 1.75%.
Yeah.
And earlier we had a comment about immigration. So you have some kind of assumption for birth rate and immigration, and there's population growth in that number, that 1.75%?
Yeah, so that would play out a lot through labor force growth and productivity.
Okay.
What
kind of population growth are you assuming?
I think in that sort of standard estimate, it's about it contributes about two-thirds of a percentage point to that 1.8.
Yeah, I'm asking what kind of growth? So there's less births, at least right now, this minute, there's less immigration, but there's got to be, I just want to know what your assumption is there.
So yeah, I'm trying to do this in my head. We take this off of labor force participation. So I'm trying to back this out into levels and I'm having a hard time thinking on my feet. The notion here is that we would see labor force participation rates sort of level out. At where they're at, maybe a little bit lower due to sort of the demographic shifts. Yeah, I can't give you you can email me later and I can do that, yeah.
How do you define restrictive policy? Is it function of the real Fed rate rather than the neutral rate?
No, that's basically it. So we can think about this in real terms or nominal terms. So if we think about it in nominal terms, if you've all looked at the summary economic projections from the FOMC, they have the long run neutral rate at about 2.5% in nominal terms. So anytime the current nominal rate is above about 2.5, that should be an indication that you've entered restrictive territory. Now there's a hell of a lot of caveats here. I mean, we wouldn't be economists if we wouldn't speak out of both sides of our mouth at the same time, right? So I'm going to do that right now. In the short run, firms, households, and professional forecasters' inflation expectations over the short horizon, 1 to 2 years, ought to affect where that short run sort of neutral rate is. And about a year ago, I estimated it was right around 3.5%, 4%. So that would put the neutral rate up a bit higher. Now, we again, as well, here I'll steal my other punchline. Even if the Fed stayed at 5 3/4 or 5.375 where it's currently at, the overnight rates. As inflation and short-run inflation expectations slow, you should see additional restrictiveness coming out of that policy standing still. So basically, the Fed stands still, the rest of the world reacts and does the job of the Fed for it. Is that clear as mud? Fantastic. I'm going to skip that. Here's a measure of labor market tightness. So this is a labor market conditions activity index, and it's a summary of about 25 different indicators of the strength of the labor market. I want to make 2 points here. Again, if you were going to argue that things are still really the economy is still really resilient, you'd point to this measure and you'd say, relative to sort of normal, which is this black line, labor market conditions are still tight. They're still sort of above normal. They're tight. Now they've been slowing in recent months, but still remain tight. And overall, non-farm payroll employment remains elevated relative to sort of what we need to keep the unemployment rate constant. So we need about 80,000 jobs per month on non-farm payrolls to maintain the current unemployment rate. We're getting about double that right now. And I'm going to use this same slide in a slightly different way later to argue that maybe that might not be the case again, being consistent with talking out of both sides of my mouth. And at the same time, while employment growth has decelerated from where it was about a year ago, it's still elevated. Wage growth is still elevated as well. So in the middle is average hourly earnings. That's actually on balance sort of ticked up, and then over the past year, it's right around 4.1, 4.2%. And we can see measures of quits rates remaining elevated. I think in the latest JOLTS data that we got, job openings spiked up again. So there's some indication that labor markets are still relatively tight. And here's great news for wage earners. Real wage growth, again, as measured by the wage growth tracker on our website, go check it out, has actually, if you squint, and you guys really got to squint on this screen, it's turned slightly positive. So wages are starting to catch up to the high inflation that we've experienced over the last couple of years. Now, I'm running out of time already. This is too bad. I got a bunch left here. I want to take a quick detour because I find some of this stuff fun. It's a fun argument to have with especially managers and C-suite folks in firms about working from home, remote work. So we use one of our national business surveys out of the Atlanta Fed, the Survey of Business Uncertainty, to do some of this research. We have a paper in the NBR working paper series about the shift to the remote work lessening wage pressures. So typically, when you experience a high inflation environment, you see shortly wage growth catches up, real wage growth catches up pretty quickly to that. And we haven't seen that quick, full catch up in real wage growth. One thing that might actually be mitigating that is allowing employees the freedom to be more flexible, work remotely more often, work hybrid schedules or fully remote schedules where maybe they're in the office 2 to 3 days a week and they're at home the rest of the time. We actually ask these questions of firms, the C-suite execs, and they're like, yeah, to make workers happy and lessen our overall wage pressures, we've engaged in this increased remote flexibility. And to the tune of about 2 percentage points overall on cumulative wage growth constraint over a 2-year period. So increased flexibility might be one thing that is sort of arresting that real wage catch-up story. And in fact, and this is maybe interesting and salient to both my point on inflation and the point that I just made, we, in concert with some of the work we did in that paper, we asked firms back in May of 2021 and May of 2022 as well, what do you think your average wage growth is going to be over the year ahead? Well, in May 2022, they told us about 5%. In May 2023, we asked, hey, what was your realization over the last year? It was about 5.2%. So they gave us something that pretty much matched in realization, their expectations from a year ago. What are they saying now? 3.6. Again, evidence consistent with this real wage catch-up being lessened through remote work. There are other margins of wage growth of working from home. There are other margins with which this is impacting relationships with workers. Increase in part-time employees, contractors, lease workers, outsourcing and offshoring as well. So these things are playing on, this dynamic is happening in the background, and it's maybe back to my earlier points about labor force and labor force growth and immigration. This might also be a factor that is lessening a bit of what we're feeling on the tightness on the labor market. Oh, and then there's a really fun slide here. This, again, you guys can't see this well, but we polled CFOs, CEOs about, do you think that people when they're working from home are more or less productive? Okay? You can guess what they said. Not more productive, less productive. But in fact, about 3.5% less productive. But we also asked workers in a separate survey, are you more or less productive at home? They said more productive by about 7%. Okay? So this dynamic, I think, is going to be interesting, and it's going to play out here over the coming years and really give us a much clearer picture about overall productivity. Right now, there's a large debate over whether or not trend productivity has increased or decreased over the last couple of years. I think my co-authors and I would argue that maybe on balance it's increased a bit, but the data is all over the place now. It's going to take economists, I don't know, about a decade to fight over this to figure out where the hell things are at. So I thought you guys would find that fun. Oh, and by the way, even though firm managers tend to dislike this increased flexibility, they think that it's actually going to increase slightly over the next 5 years. So they don't think they're getting away from it as much as they complain about it a little bit. Oh, okay, all right, let's get back to the story. Now, I just got done showing you that real GDP growth has been elevated. But what if we measure overall output instead of on the expenditure side, which is what most people talk about, GDP, let's measure it on the income side, gross domestic income. In theory, these things ought to be the same thing. Right now, they're not. And even after the revision we got at the end of last month, usually this gap, which folks refer to as statistical discrepancy, tends to go away. It didn't. Real GDI is basically flat over the last year and is telling a conflicting story with where GDP growth is at. Now, I'm going to say something, again, this is my opinion. The last time we saw this was late 2006. I think we all know what happened later. That's as far as I'm going to go on that. I like my job. But anyway, real GDI says that things have basically stalled out a bit. Yes?
Does GDP lead GDI?
So this is actually, it tends to go the other way. Especially if you kind of squint and sift through the data. And in fact, the BEA actually has started producing an average of the two. So it tends to be the case when these things diverge upon revision, GDP growth tends to get revised more in the direction of GDI than GDI gets revised in the direction of GDP. That didn't happen this time. And that's actually kind of interesting. I don't have a great story for why that's the case, but it remains interesting. On the labor market, we can construct a variety of measures to measure sort of tightness in the labor market, and those measures are starting to say that things are becoming less tight, and in fact easing a little bit over the last maybe 6 to 8 months or so. And this is consistent. We do a lot of work at the Atlanta Fed, actually engaging in not only in surveys, but in face-to-face interviews with C-suite execs throughout the Southeast. And their soundings are very consistent with this, that turnover rates inside their organization have slowed markedly since the end of last year, and hiring has become, on balance, a little bit easier. The other thing, here's that same slide that was in green. I've now broken it up into pretty blue and orange colors. This is another interesting fact, and it points to a broad slowing in the overall employment trajectory, except for healthcare. And those orange bars are what's happening with healthcare. So healthcare employment has been on a tear. It continues to be on a tear. It's about 14-15% of the overall employment is in healthcare, and that share is rising. If we subtract what's happened recently from the overall top line, non-farm payrolls have slowed to about 65,000 per month ex healthcare. That's the suggestion that maybe throughout the broad economy, the employment growth is slowing, and the secular upward trend in healthcare employment is sort of obfuscating that pattern that we normally see. Now, the other thing that's kind of interesting here, and we've either all experienced this on trips to Italy over the last few months, or the unleashing of pent-up revenge spending that folks have engaged in, and some of the kind of silly math that people are engaging in now on TikTok, which is kind of fun. We've seen a dramatic increase in spending over the last couple of years, so much so that the personal savings rate has declined sharply. Some of that can be explained by what's happened with what we'd call excess savings. So excess saving during the pandemic at the high end was folks were shuttered at home. They weren't engaging in services spending like they normally would. They weren't going on trips and vacations or going out to eat. And they basically banked that additional saving. At the lower end, there were a series of successive rounds of support for households that, when you dig into the data, households actually used to pay down debt. So student loan payments were stopped during the pandemic. They just actually started this month again. And that just student loan payments alone allowed households to save an additional, I think, $280 billion, a huge amount. And they used a lot of that to pay down debt, pay down credit cards, pay down other debt, get into it, and over the last year or so engage in some really fun activities. But that sort of excess saving, that's pretty much dried up. In fact, this estimate says there's maybe a little bit left. Some other estimates say it's all but gone. Yes?
I thought there was an NBER paper a while back that showed on the student loan payments that the kids, largely kids, not only didn't save the money, but they actually ran their other revolving debt up to absorb their newfound cash flow. So, I mean, not only did not save it, they didn't just spend it, they increased their debt to absorb, so the interest would absorb it.
That's interesting. That sort of flies in the face of what we know from the consumer, the survey of consumer finances, the SEF. In that micro data, it actually looked like household balance sheets across the income spectrum became much more hale. There was a lot of balance sheet repair that happened during.
I agree with that, but it looks like the student debt piece, people had in their minds that there's this much in payments every month,
and then they just
get back there.
Yeah, so I'll have to think about how to square that. That actually makes my argument even more salient. Is basically going forward with personal saving personal savings rates that flow into saving dwindling. Excess saving from the pandemic is all but dried up. The support for ongoing, really robust consumer spending may have dried up. And if that story is true, we ought to see personal consumption and expenditures slow markedly over the next maybe 6 to 8 months. Okay. I want to leave some time for questions, but basically you can see that the Fed has increased rates markedly since March 2022. In fact, this is the sharpest, swiftest increase in interest rates that we've had in quite some time, up to a little over 5%. We've seen mortgage rates adjust. This is causing, some very interesting dynamics with residential investment. We've seen residential investment tank. It's causing interesting dynamics in the housing market at the moment, especially coming off of very low rates. But at least inside, when transmission of short-run rates to mortgage rates, that seems like that's working sort of as we expected. But there, and here's residential investment. I'm going to skip ahead real quick to this picture because I'm running out of time. We have yet to fully see the sort of typical restrictiveness or that monetary policy transmission play out on the firm side of the equation. And in our surveys, and again, you guys should have this slide deck to peruse at your leisure, you can see that we're seeing some growing impact of rates restraining capital investment. But one of the reasons why we might not have seen as much as we typically would expect in terms of restraint on CapEx has to do with the environment we were in just a few years ago prior to raising rates. So short-run interest rates were basically on the map during the pandemic. And I know you guys can't see this, but this huge spike here is net issuance of bonds by non-financial corporations. So basically, firms took this time when interest rates were very low to refinance all their debt and get in solid positions, and financial, non-financial balance sheets underwent a significant amount of repair during that period. And the story basically is that firms are or have been flush with cash due to this, due in part due to this refinancing when rates were really low. That here over the coming, these maturities are about, on average, about 5 to 7 years. These are going to start coming due and having to be refinanced at much higher rates if short-run rates stay kind of where they're at in the moment. Yes?
You said it's net issuance?
Yes.
So wouldn't that be net of any refinancing? You said that they issued debt to
yeah, no, you're right.
So it's net.
No,
that's
you're right.
Actually buybacks of stock. That's increasing the leverage
Yeah,
of your
no,
capital
you're
structure
right.
at lower
Yeah,
rates.
you're absolutely right. You're absolutely right. But they basically took this period to make themselves very, very healthy and increase their cash balances, right?
Or leverage.
Or leverage. But in the next coming years, there's sort of this wall of refinancings that's going to happen. Okay? So it's a story that the transmission of tighter monetary policy has yet to fully impact non-financial corporations. But in short order, it ought to be happening soon. Okay, we can talk a little bit about the fiscal policy, but fiscal policies, especially the IRA, is playing out and is starting to already, and I'm going to skip ahead. Again, you guys can check out those cool pictures. It's already starting to impact structures investment. So structures investment is calculated on a flow basis, not when the project's completed. Some projects are already breaking ground and is pushing up structures investment. We should see this play out over time as a boost to overall investment both on the government side and on the non-residential business side of the NIPA accounts. But this is providing some further stimulus. Okay, monetary policy response. Last time the FOMC met, they held rates flat, wanting to gather more data to make that next decision on where the Fed funds rate's likely to go. The median projection coming out of that meeting was one more rate hike by the end of the year. And then a period where, especially as inflation and inflation expectations, inflation and short-run expectations soften, a period of restrictiveness at least over the next few years. So this is, by the end of 2025, the Fed funds rate remains at 3.9% on nominal terms, which is still quite restrictive. And until recently, and this is sort of the interesting part, you can't see on this picture, look at it later, but until recently, market participants were saying, that's not going to happen. The Fed's going to start cutting rates early or in the middle of 2024. Those most recent projections, the most recent market implied probabilities actually align pretty well, and those are the red dots here, here, and here with the FOMC's projections. Some of that, I think, is what's happening on the real side with growth, that market participants had a story that there was going to be a recession. A lot of them have been calling for a recession for the past couple of years, and maybe they've been disabused of that call going forward. I think I'm gonna stop here because I'm out of time. I'll stick around and answer questions if you guys want to answer questions or ask some questions. But basically, the argument is this. Right now, the Fed is digging through the data to try to figure out whether or not those signs of resilience are in fact the true signal of where the underlying strength in the economy is versus the signs of slowing. In my personal view, I think we're seeing some significant slowing, and we're likely to see it, especially as we head into 2024 and the first part of 2024, as consumer spending likely slows due to the drying up of a lot of firepower for additional spend. Okay, this is something I'd like to just leave you with. Again, you have this in your deck. We do a lot of survey work at the Atlanta Fed. It helps us, especially when our macro models break down, make sense of what's going on in the economy at the moment. I'd urge anyone who would like to sign up and participate in this survey. There's, other than just, you guys really like the Fed and want to help out, there are some legitimate reasons to participate in this. One is it helps us actually make better policy. It helps me give better policy advice to my president, who takes that to the FOMC and shares that around the table. It allows for a conversation between what you guys are seeing and what we're seeing. It allows you to participate and converse with policymakers, and it gives us real-time feedback on current issues. And it helps make our policy even better. So feel free. I'd urge you to sign up if you'd like. So I'll stop there, answer questions, and yes.
I just would like to check the room and make sure nobody else has raised their hand.
No, you beat them to it.
All right. So I may have just imagining this, but it seemed like the decline in interest rates during the 80s that ride down from 10 to 2.
Yes.
That my generation experienced, it was an opportunity to buy long duration assets that significantly inflated, right? Interest rates come down, long duration asset prices go up. Bonds, real estate, you name it. But it seems like this forecast has rates coming down faster than maybe they did in the past, or the expectations coming down faster. So I'm just wondering how this is going to impact the people who have like 3% mortgages now, and they're going to be less inclined to move, or people who are postponing purchases, not understanding that the rates are going to come down so fast. So I would argue that 2025 remaining elevated is kind of slow. Overnight interest rates didn't have as far to fall as they did in the early 80s. I mean, remember, interest rates had peaked in the early 80s around overnight rates around 20, maybe even a little bit above 20%. They fell pretty rapidly, I think, relative to this. If we did it like a z-score and scaled this in the same direction. This is actually a notion that the one interpretation of this elevated stance, even as I think growth projections by 2025 and inflation projections are pretty much well in line with what the FOMC would consider full employment. One interpretation of this is it's guarding against sort of upside risks on inflation. Again, I don't necessarily see that as a base case, but yeah. That's a good question. Yes?
That comes back to that. I'll go back to your slide where GDI.
Yeah.
And reference 06.
Mhm.
And I think might explain that gap about financing activities into the housing sector fueled by subprime mortgages, for example.
Sure.
Because, of course, the Fed continued to raise and thought we were going to a soft landing there. So my question is based on that experience of the Fed and all the research, is there any work being done to explain that gap? Because it could be another financing activity and with the growth of private credit, for example, and for investors hunting for nominal yields regardless of the underwriting. Does that come up at the Fed?
I don't have anything ready for prime time yet, but the angle that I think some folks in our department were digging into was more along the lines of corporate profits, which may be related to some of this search for yield activity. I got to think about that a little bit. But yeah, no, there are folks around the system that are engaged in sort of trying to dig through these data and figure this out. I don't have much more to share than that at the moment. Yes?
So you kind of shared that your outlook was conservative, if I heard that right. But I'm
Yeah, I'm Goldilocks, man.
gonna take another crack at that. And I wonder if you talk about the difference between leading and lagging indicators. You know, you talk about employment being pretty strong, maybe rolling over a little bit. But you look at something like an LEI, it's super negative. So what are your thoughts around that?
And LEI for everyone.
The leading economic index.
Oh, from the conference board? So we know that at best, the unemployment rate and employment growth are coincident, right? We look at some of these other measures of tightness. I think they're a part of that leading economic indicator index from the LA. I think stock markets are in there too, and some other things. I don't want to really, yeah. So I don't want to poo-poo anything. I'm on video here. I got to be careful. When you look at indicators, and I had a couple actually that I trust a little bit more, maybe than I look at as well as the LEI. Maybe that's a better way to put it. Keeps me out of trouble. We can see in direct measures from firms on their expectations for sales revenue and employment growth, those things are slowing pretty markedly. Again, when we go out and poll businesses, they're telling us they're expecting things to come off the strength that we've seen. And you can see this historically in the employment and unemployment space, employment in particular. That thing can shift pretty quickly. And in fact, in real time, there are these really nice finger plots on revisions as you're heading into a softer period of growth. That it tends to get revised out. There's a pro-cyclical downward revision when you enter into those. So again, my view is that things are slowing. They're slowing materially. I think my boss has been out in public saying we're in a pretty good spot right now. Pushing further might engender, conditions to slow much more swiftly than what we kind of hope happens, that sort of golden path. And that would cause undue harm on the economy in the name of trying to get inflation down, where if you really parse through the inflation data, it's looking pretty okay right now. We may be on a path, we may be at the point that, if and again, my boss has said this, so I think I'm safe. If we kind of hang out where we're at now, things will end up with a much better overall situation. Sorry, that's a really bad non-answer, but I'm on camera. Yeah.
So much of that, what you have on there is tied into real losses.
Yes.
Why they do 2% as their inflation target. But when it first came about, it came from an environment where you had trade barriers coming down, you had labor market being, moving overseas. So are they still dogmatic to not want to play with that inflation target in the framework of, well, we're doing de-risking of China with this, so the other wall's coming back up. How do you get down to 2%?
domestic inflation target.
Ah, you're trying to get me in trouble. Let me say it this way. My view. You don't move the goalposts when you're not hit target, basically. If you say you're going to get to 2, you do whatever it takes to get to 2, and they've said, my boss has said this, we're going to get to 2. Okay, that's happening. I think the actual likelihood is pretty strong for getting back to 2. Now, I think what you're asking is 2 the right number? Okay? And I have some sympathy with that view. Maybe it's 3%. Maybe we ought to think about more of a flexible price level targeting that would explicitly try to account for periods when you had very high inflation and on average deliver something in the long run that equals sort of a 2% trajectory for prices. I'm very sympathetic to that argument. I think that helps long run investors. I think that helps households make better decisions on what to do with whether or not mortgage rates are too high at the moment and what they want to do with their housing situation. So I think that's, I actually think that may be a step in the right direction from my view. The likelihood of that happening when inflation's still running at a rate that's elevated, I mean, the optics around that look terrible, right? We weren't able to get to 2, so we're just gonna say it's 3. I can't imagine a scenario where that turns out well. Especially because you guys are all smart folks. You know, firm decision makers are all very smart folks. If we start playing the game of, well, we can't quite hit that target, let's pick this target. Well, what are you guys going to think? Oh, there's no way they didn't hit that target. They're not going to hit this one either. And then we'd likely see a significant increase in inflation expectations. Wouldn't matter what the hell the target is, we're not going to be able to hit it, right? I believe that the entire Federal Reserve System engages in the FOMC in particular, engages in periods of revising and looking at their long-run principles, their monetary policy principles. I believe something's coming up in a couple of years where there will be a reevaluation and digging through a lot of this literature on price level targeting versus average inflation targeting. So I don't think the case is dead. I just don't think it's happening now. Yeah.
Maybe some comments around Fed independence, obviously elections coming next year.
Nope.
Debt service is about 14% of tax rate.
Nope. Not going to do that. Yes. Sorry. I can't comment on anything like that. We're an independent organization. Congress can decide what they want to do with us, but I'm not going to make any sort of comment on that. Yeah.
So inflation comes back down to 2%, then what? As the rate, how long does it need to stay at 2% before we're comfortable?
That's a great question.
We're okay starting to.
That's a fantastic question. So the question for the group was, suppose we get to 2 at some point, maybe early next year, mid next year. We're at 2. The year-over-year growth rate and inflation's at 2. It looks like we're hitting that sort of golden path. How long are we going to remain? How long is the FOMC going to keep a very restrictive stance, or how long before they start cutting? Fair? Okay. Here's the SEP says that they slow 50 basis points at the median. And there's a lot of diversity around that. There are some folks that would much rather have it hang out kind of where it is until they're completely sure. And again, I think a lot of this, in my view, goes back to the historical experience we've had with high inflation episodes. Chairman Greenspan was famous for saying, price stability is achieved, and I'm paraphrasing because he speaks even more out of both sides of his mouth than I do. I'm paraphrasing. Price stability is achieved when no one cares about inflation. Everyone still kind of cares about inflation now. We're not quite there yet. So I think that in that sense, there's likely to be some sort of tilt or thrust towards remaining restrictive until the FOMC is completely sure that any sort of further inflation threat has been extinguished. All right, one more. I got to get out of here. Yep. And you guys got to get back to work. What the hell? Anything else? It is fun. Anything else? All right, fantastic. Thanks, everyone. Appreciate it.